Welcome back. Today, we're throwing on our equity analyst hats and diving straight into a rigorous valuation masterclass for UFP Industries, or UFPI. We aren't just glancing at stock charts today. We're tearing down the financials using absolute, relative, and asset-based models to figure out exactly what this business is intrinsically worth. Just look at this massive number. If you had bought UFPI 10 years ago, you'd be sitting on a 964% return. That's some serious decade-long wealth creation. But you know how the market is. It's a very what have you done for me lately environment. Over the last 12 months, the stock is actually down about 13.5%. So the big question we need to answer today, is this recent dip a fundamental breakdown or a seriously rare buying opportunity? Here's how we're breaking it down today. We'll start with the challenge and our baseline assumptions, then run through absolute valuation, residual income, relative valuation, asset-based valuation, and wrap it all up with our final verdict. All right, Section 1, the challenge and assumptions. Listen, you literally can't build a valuation without clear assumptions, right? Our raw data is packed with great metrics, but it doesn't give us a stated discount rate. So stepping in as your analyst here, I'm plugging in a very sensible 8% weighted average cost of capital, or WACC, along with a standard 5 to 6% market risk premium. We're also going to lock in a conservative 2 to 3% terminal growth rate. These are our anchors moving forward. Moving on to Section 2, absolute valuation. To really make these absolute models sing, we need to extract a couple of massive clues from the data. First up, UFPI is rocking a super healthy 5.71% free cash flow yield. Second, their 5-year dividend compound annual growth rate is sitting at a very impressive 19.08%. The step-by-step logic for our discounted cash flow and dividend discount models is pretty straightforward. We take those robust, growing cash flows, project them out into the future, and then discount them back to today's dollars using that 8% WACC we just established. And wow, the result of that absolute math is pretty eye-opening. Our DCF model spits out a fair value of exactly $114.76 per share. Now put that right next to the current market price of $85.18. Based purely on the cash-generating horsepower of this business, we're looking at a stock that is trading at a really steep discount. Section 3 now, residual income. Now, if that DCF result feels a little too optimistic to you, we can ground our valuation in reality using the residual income model. Think of this as simply the economic profit a company makes after paying rent to its shareholders. It's a fantastic value test because it starts with what the company already owns, its book equity, and only gives them extra credit if they generate returns above their cost of capital. So let's break down this reality check. We take the current $85 price and divide it by their 1.57 price-to-book ratio, which gives us a baseline worst-case floor value of about $54 a share. But here's the kicker. UFPI generates a return on equity of 9.36%. Since that easily beats our 8% cost of capital, they are officially creating positive residual income. That adds a nice premium right on top of that $54 floor, proving the intrinsic value sits comfortably higher than just the baseline equity. Okay, Section 4, relative valuation. Now, the source data we're working with focuses entirely on UFPI's internal numbers and doesn't explicitly name competitors. So we've got to make a professional assumption here. We'll benchmark UFPI against standard, publicly traded peers in the cyclical building materials and lumber sector. We're talking about companies like Builders FirstSource or Boise Cascade. Let's treat these multiples like a report card. Their trailing PE of 17 is actually a bit higher than the 3-year historical average, which, might make you pause for a second. But look a little deeper. The EV to EBITDA, which gives us a much cleaner picture of raw operating earnings, sits at just 7.80. That's lower than the historical average. Plus, that price-to-book ratio is significantly discounted compared to where it usually sits. So, relative to its own history, it's a bit of a mixed bag, but one that definitely leans toward a fair, if not discounted, valuation. Which brings us to Section 5, asset-based valuation. Here we strip everything down to the studs to find the net asset value. Assuming the book assets closely mirror fair market value, the metrics are frankly staggering. UFPI has an enterprise value to assets ratio of practically 1-to-1. And even better, their debt to equity is incredibly low at just 0.08. Throw in a massive current ratio of 4.59, and you realize liabilities are almost non-existent compared to the assets. The takeaway? Your downside risk is structurally capped by an absolute fortress of a balance sheet. All right, finally, Section 6,
The final verdict.
It's time for the grand synthesis. Weighing all these models together, our residual income and asset-based models highlight a rock-solid floor starting around $54, heavily protected by that near-zero debt. The relative multiples point to a fairly valued market price right now. But because UFPI operates in a cyclical business, relative multiples can get pretty noisy. That's why our absolute DCF model stands out as the most reliable indicator of true upside here, pointing to an intrinsic value of $114.76. Basically, we're looking at very limited downside with high cash flow driven upside. And all of this math culminates in one definitive, crucial number, a source calculated margin of safety of 25.77%. That means you're essentially buying a dollar's worth of business for about 74 cents. For equity analysts like us, finding a company consistently generating positive returns on equity while offering a nearly 26% margin of safety, that is literally the ultimate goal. So given the pristine balance sheet, that impressive history of dividend growth, and a deep intrinsic discount to fair value, this explainer paints a really compelling picture. The recent 13% drop in the stock price just feels totally disconnected from that $114 per share cash-generating reality we mapped out today. So I'll leave you with this. With the margin of safety sitting at nearly 26%, is the broader market focusing so much on short-term cyclical fears that it's completely missing the long-term compounding forest for the trees? Keep digging into those financials, and we'll catch you in the next explainer.